Hey everyone, welcome back to WorkTech. It's George LaRocque, and I've got something really interesting to share with all of you today. My friend Jason Corsello, the founder of Acadian Ventures, put some really interesting data out into the market, and he's here to tell us all about it. Jason, welcome.
Hey, George. Thanks for having me. Good to see you.
Yeah, well, I don't want to steal your thunder. Well, I'll let you tell everyone what you've released and what it's all about.
Yeah, so a little bit about Acadian Ventures. So we're an early stage venture capital firm focused specifically on what everyone likes to call the future of work. It's a segment that both you and I have been involved in for a very, very long time. And so we've been tracking this market for a long time, as you have as well. But we look at it from very much a early stage investor lens, and we try to get data from all over the place and try to interpret data as we make investment decisions. So today, I'm excited to share what we're calling the Future of Work 100. It's been a bit of a passion project for me. I've been working on it literally for years in terms of compiling the data, analyzing the data, and we've reached a point where we want to put it out into the wild and see what people say. But it's essentially a list of what we believe are the top venture-backed future of work companies. And these are companies that have been where investors have backed them. Some of them are very large, multi-billion-dollar companies. Some are smaller than that. But we've tried to create a fairly unique ranking. It's not just based off of valuation. There's some other metrics in that of what those top companies are. Maybe it will create some debate or discussion, but it's something that we wanted to share to really try to educate the market of what's happening, provide some context of where we think the market's going, and try to dig into a little bit of some unique snippets of what we think is happening in the market.
Yeah, I really applaud you for doing this, and we'll dig in a little more. But I think there are two types of data that's prevalent about the market, and there's sort of the general sort of B2B, B2C, VC data, which for whatever reason they don't do a good job categorizing this space, and it reflects a lot of the investors. Education's needed. And then you've got very like reactionary, like, what happened last month or what's happening today. I try to tell people you've really got to have a wider lens than that. And this really is a nice wide lens on the market. So I really, when I saw this, I really appreciated it. So that there's more than that list of 100, but you referenced the factors that go into the ranking, and it does start at 1 and go to 100. I noticed that it clearly wasn't just about how much they raised or what the valuation was, because it was out of order if that was the case. But so how did you rank, or what were the factors?
Yeah, so I guess the first step is creating that curated list, which we track. Many of the companies that get funded. We've been tracking it for over 10 years, right? So there's really been thousands of companies that have been backed by investors, venture capital investors, over the last 10 to even longer than that years. So first is capturing that list, and then we start to look at some core metrics of those companies. Some of it we compile ourselves because these companies are private companies. Oftentimes it's hard to get data, and it's not always perfect. So what we've tried to do is accumulate this data over time and look at a couple of factors. One is valuation, right? Valuation is important. And just like anything in whether it's real estate or something otherwise, valuation matters because someone has put a price on what they believe the value of this business is. So, it certainly can be debatable, especially today. Valuations have certainly, by most observers in the market have gotten over inflated in the venture world over the last 3 or 4 years. But valuation has been a key component. But we also look at another core metric, and we looked at all kinds of different metrics. And the one we concluded on is revenue per employee. We think revenue per employee is a really, really important metric to be tracking, because that essentially is an indicator to a company's efficiency, right? Just because you raise the most capital at a high valuation doesn't actually mean you're running the business efficiently. Right. So what we did is we essentially created a calculation that looks at both valuation combined with the revenue per employee. And decided, and that's essentially how the rankings work. So we've exhausted a lot of time and energy putting this together. Part of that is obviously looking at the number of employees, which, sometimes can be generally available. Sometimes you have to go to the companies. Sometimes we actually had, as we were compiling the list, companies come back to us and said, hey, we're not this, we're that. But the long of the short to your question is we think revenue per employee is an important metric, and certainly, there's lots of unicorn lists out there. It still matters, but I think we're starting to see the shift in market where efficiency is going to be a bit more important, especially in a more capital constrained environment that we're seeing now, and we'll probably see for a while, at least for the next couple of quarters.
Yeah. Yeah, that's I couldn't agree more. And but I'm curious to stick on valuations for a moment. I get asked about valuations, every time I talk to a founder, any investor, and the question's always, what are you seeing? What's happening? And I'm curious, I'll put that on your plate. How has that landscape changed? What are you seeing when it comes to valuations?
Yeah, so I'll give you one headline, which will be published on futurework100.com, which is of the top 100 companies that we looked at, the median valuation or ARR multiple, annual recurring revenue multiple, is around 20x. That's a last 12 months, LTM is the acronym used, last 12 months multiple, which is 20x. So many would tell you, and I'm in this camp, that is probably much overvalued in today's market, right? Because for a lot of these companies, so of this list, there's 64 companies that are valued over $1 billion. So typically what you find is for those companies, there is oftentimes a public market comp, right? You can look at ADP or Workday or ZipRecruiter or go down your list of the nearly 50 publicly traded companies, right? So there's a comp that the public markets have set for those companies. And it's, on average, probably somewhere between 5 and 8x in the public markets today, right? Yep. On this list, in the venture-backed markets, it's 20x. So that would tell you the markets are overvalued, have been overvalued, will continue to be overvalued for a period of time. So, the next thing is then what happens next? And we can talk about that. But I think we've certainly seen a lot of capital come into this market as well. It's no exception. So that, this is essentially a byproduct of the free money over the last 4 or 5 years that we've seen. And these are cycles that happen. And so I think we're going to see a natural cycle of compression of these multiples. It's inevitable. I think, the bigger question is what happens to a lot of these companies that were overvalued, overfunded, and are out at this inflection point.
Yeah. Yeah. And timing, right? When did they raise? What was their burn rate? For how long?
Were their investors? Yep.
Right. But that sort of range or the ranges, that 5 to 8 range, that's the ballpark, I think, these days from what I'm seeing. If you're at the top of that range or you can do a little better than that, it seems like that's where the conversations are happening. And when I say that, I'm not, providing any inside baseball here. It's, this is with founders who are thinking about, and based on their foray into the market, that seems to be the ballpark.
Yeah, I guess one caveat to the George is, typically what you see with private venture-backed companies, they're growing faster than their public market comps,
sure,
public market peers, right? So that would command maybe a little bit of a premium on that revenue multiple, but certainly shouldn't be 3x or 4x, right? And so this is where we're going to see that, that compression and more, more closely tied to the public marks, but. Yeah. It's never perfect, right? But now is a time, and I think we're going to see probably over the next 4 to 6 quarters of this big reset happening, particularly on the late stage venture markets or the late stage companies that have raised, 200, 300 million. The average company for on this list has raised 200 million for the billion-dollar plus companies. They've raised over 300, nearly 350 million on average. So they've raised a lot of capital.
Yeah.
And so a lot's going to change in the next couple of quarters.
Yeah, there were some other really interesting headlines or insights that you shared in this. Whether it's looking at where the companies are located or where the capital's coming from, it's a global market. And I forget what you used as a headline, but it's, Silicon Valley is not the center of the universe or something like that any longer, or it's starting to shift. Can you talk a little bit about what
Yeah,
surprised you there? Or
the end of Silicon Valley dominance, I
there it
guess.
is. There it is. Yeah.
Yeah, I mean, Silicon Valley is still very important in terms of a foundation for venture-backed companies. But we've seen a big shift in a couple of things. One is companies can be started anywhere in the world. So I think of the list, there's nearly 15 countries represented. I think it's more than that. I don't have that at my fingertips. It's certainly in the
That's right.
on the website, but there's all geographies are represented. Countries like Chile are represented. Countries like Singapore. So there's a wide diversity in terms of companies and their headquarters. So companies can be started anywhere in the world. We've known that over the last couple of years, but I think this list represents that. Secondarily, and I think we're going to put out more data on this, is there's a real big gap or disparity between the companies that are funded that are based in Silicon Valley and everywhere else. And I guess the key highlights are, one is most companies in Silicon Valley raise a lot more capital at much higher valuations, and their revenue was lower than their peers outside of Silicon Valley. So it's a really interesting dichotomy of the list. And I'll give you one kind of last interesting highlight is for the companies in Silicon Valley, their current ARR multiple is about 25 times. So that's higher than the 20 times average. If you look at the companies outside of Silicon Valley, it's about 12 times, or in Europe, I should say it's about 12 and a half times. So European companies on an ARR multiple are basically half of that multiple as their Silicon Valley peers. So to me, I think that what that suggests, and it's something that we've been watching and we've been investing ourselves, is looking at companies outside of core Silicon Valley, because we think you can build better companies more efficiently that have to raise less capital, so you're less diluted as an investor, and you can build very, very strong, healthy companies.
Yeah. I find that when I'm talking to investors, for all the reasons you just stated, any investor outside of Silicon Valley, when they're looking for deal flow, they want to, stay away from Silicon Valley, and it has a lot to do with the metrics you just shared. At the same time, it's almost the investors outside of Silicon Valley in the U.S. as well as globally are really targeted by. I mean, I guess it makes sense culturally, but do you find that the startups outside of Silicon Valley have a hard time going to Silicon Valley, raising earlier money? That I see that a little. And it's almost like, people like to raise and invest sort of where they are, if you will. Is that just happenstance, or do you see that as well?
No, definitely. I mean, we've even seen it with our own portfolio. As many of them want to go to Silicon Valley, it's like a badge of honor, right? You've got a Silicon Valley VC that's invested in your company. And there's something to be said for that, right? There's fantastic, and this isn't, by any means a way to bash investors in Silicon Valley. Some of the world's best investors sit in Silicon Valley, and that's going to be, that's not going to change for a long time. I just think we're seeing a leveling of the playing field, right? Whereas, you can raise capital anywhere in the world, right? There's great funds in Europe today. There's great funds in Southeast Asia. There's great funds in Latin America. So it's not just, you make the trek to Silicon Valley to raise capital. capital really has become very dispersed, and that you can raise anywhere in the world. I mean, we've co-invested with funds in Africa. We've co-invested with funds in Singapore. We've co-invested with funds in Latin America. So it really, I think we're over the next 10 years, the way I think that we're going to see this, a continuance of this, that it's no longer going to be, you're going to have to depend on capital out of the valley to fund your business. There's great funds that are emerging everywhere in the world.
Yeah. Well, you used the world is flat as the intro to talk about this section. And I think 100% the Silicon Valley is still, the place where we all look to see what's happening from a trend perspective, and whether it's tech or investment. But the world is flat has impacted our market when it comes to talent, when it comes to skills availability, all of the macro trends that are driving our market on the buyer side and on the tech side impact Silicon Valley too, whether it's investors or talent, any type of talent. So it's I always say what we said in the 90s is finally coming to bear in a way that we all really feel it every day. So you called out a few trends like that as well, and I think I like the way you put it. Managing talent has become an existential crisis for every company, and I noticed some disbursement of the funds across this 100. HR and recruiting were the top categories, but were there any trends that really within those bigger categories that stood out for you that you're focused on right now?
Yeah, I mean, it's a really good question. I'd say nothing that we've been able to diagnose just yet, right? So as you know, like HR, payroll, and recruiting have been long the most invested or investable areas. I think if you look at the top 10 on the list, a lot of them have focused on productivity and collaboration. So companies like Miro and Airtable and Notion, and that's been an emerging trend over the last 7 or 8 years of companies like that emerging that are just making us more efficient and more productive. So that's probably been the most interesting trend in terms of categories of investment over the last 5+ years that didn't really it existed, but it's become much easier to use those tools than ever before. I'd say kind of one last area that we've been exploring as investors is emerging markets. I think there's just a really interesting opportunity in emerging markets. It doesn't necessarily suggest it in the Future of 100 list or any of the rankings, but if I was going to throw my crystal ball out, I'd say we're going to see a lot of companies emerge on the list in the next 10 years, assuming we continue to put this list together in 10 years of companies that are in Nigeria or Nairobi in Kenya, or in places that haven't necessarily been on venture capital lists more recently. So I'm excited about that. I mean, one of the top investors, or the top investors in our category, has been Y Combinator. And Y Combinator, invests everywhere in the world these days. We've invested in companies that were Y Combinator companies that are located in emerging markets. So that's one area I'm super excited about, and we've been investing ourselves in.
Yeah. There's a lot there to get excited about. I think the adoption is going to pull those markets right along. And, of course, they'll ultimately do business outside of their region as well. But it just represents not just a new market to bring these products out, but, in some ways, the more established markets like the US or Europe are on older platforms and bought into. There's a change and a transformation taking place, whereas these companies are capitalizing on newer technology and usability that in the SMB and those emerging markets that We just really started to see, in my opinion, post 2010. So it's I think it's going to happen really fast, as those markets adopt and start to see the value from the tech. So
Yeah,
um,
and they're huge markets. I mean, many of these markets are 3 times, 4 times, even 5 times the size of the U.S., right? So the big concern I have in the U.S. market right now is there's just a saturation of products, right? There's just, I mean, there's literally, hundreds of employee engagement solutions. Whereas in some of these markets outside of the US, there are a lot of greenfield opportunities that are much larger than the US market that we all know about. But we don't know the sizes of some of these other markets, which are just massive, right? That haven't had access to technology, that haven't had the ability to buy technology because it's either been too expensive or it just hasn't existed because there's a lot of local requirements for that product, right? For that HR product, or that payroll product. So, again, it doesn't necessarily showcase in the list today, but it's something that I think we're going to see change over time. And one of the things I'm excited about doing over the next couple of months is start to dissect some of the data that we have in the list and start to share what's happening in certain segments of the market outside of the U.S. in certain categories, because I think when you start to dig in the data, some pretty interesting trends that aren't necessarily apparent when you just look at the surface level.
Yeah, well, I think there's a lot of consistency to what we put out quarterly. We look at where the money's going. We look at the categories, subcategories, but we also look over the last 7 years, and look at that, how it was dispersed. And as I was scrolling through this, I was just nodding, like, yeah, this is all very, I align, our data aligns with this. We're of course, to your point, this is a list of the top 100. So these are, many of them are later stage than what we're seeing quarter to quarter, but still the trends are what they are from a category and regional perspective. Anything else you'd like to leave everyone with as far as, where to find this, or how you'd like them to perceive it?
Yeah, I guess a couple last things to leave you. So first of all, the list can be found at futureofwork100.com. And I certainly appreciate folks' feedback to the list. I think we'll probably go through some iterations over time as we start to dissect those. One of my limited partners, investors in our fund, said, is this list going to be the same in 12 months or 24 months? And I was joking. I said, well, maybe the future of work 50 next year, because I think this list is going to change quite a bit. As we talked about, and the key highlight I think that people are going to see is there's just been a massive I shouldn't say overfunding, but a massive funding. And as we talked about from the beginning, a lot of these companies have raised a lot of capital at pretty high valuations, and a lot is still going to happen in the next 12 to 18 months. Either companies need to grow into those valuations, or they're going to have to raise more capital because they're still burning a lot of capital. So I guess the net is there's going to be a lot of movement in this list over the next 12 to 24 months. And I'm excited to watch it evolve because, it's not always who raises the most money wins. I've seen a lot of companies that have bootstrapped. I was at one of them, Cornerstone On Demand, that didn't raise a lot of capital. I think over the span of Cornerstone before we went public, we raised less than $50 million, right? Which is unheard of, in today's market. So there's a lot of companies that I think are gonna show up on the list that didn't. And I think what hopefully this list will also do is it will highlight that companies need to build a lot more efficient than what we have over the last 5 years. It's not just about how much you can raise and telling your friends you raised from great investors. It's about really building long, sustainable, enduring companies. And that's what I'm excited about as investors. We're going to build really good companies. It's not just going to be about a race to who can win, who can raise the most capital and try to grow as fast as possible.
Yep. Well, that's what we like about Acadian, Jason. It's you've been in this market. It's more than a trend for you. It's there's a lot of goodwill that you bring to the market. Things like this list as a great example. I know how much time it takes to vet this data, compile this data, and put it out there. So kudos to you and everything you're doing. And thanks for coming and helping tell the world about it here at WorkTech.
Cool. Thanks for your continued support, George. I appreciate it, and love what you guys keep doing.
Great. Thanks a lot. And thanks everybody for watching or listening. And until next time.